Thanks for tuning into Talking Point. I am Neeraj Shah, and our guest today is Vikas Khemani, founder, Carnelian Asset Management and Advisors. Vikas, great having you as always. Thanks for taking the time out. Hope all is well.
Yes, hi Neeraj, good to see you. Always great to chat with you.
Thank you so much. The feeling is entirely mutual, Vikas, and would love to get your insights, Vikas, into some developments that have happened recently before we move to some of the fantastic newsletters that you guys have written. But BOJ has made a tweak, much anticipated, but the tweak has finally happened. We're on the cusp of another Fed policy as well. Central banking action, how crucial would this be in the near term, particularly the BOJ move, which has already happened?
I think, there's no denial that, I haven't really sort of, tracked what's happening. But more importantly, I think if you see, the Fed has already indicated that there will be a cut over this course of this year. Couple of them, and interest rates are peaked out, and it's only a matter of time how it sort of comes down. And and I think we will have to see in that context. But see, as far as the Japanese rates are concerned, they have been in a very, very low trajectory from a very, very long period of time. So I won't read as much as Japanese economy is recovering after a very long time. We've seen a lot of positivity around that. So, but I would say that globally speaking, my whole view is that US rates are coming down. It could be delayed. It could take time depending on a lot of data dependency and all. And that will determine a lot more global macro factors, because I think that's where a lot of rise had happened in the last couple of years. I wouldn't think that very very big impact would come from Japanese interest rate movement. This is only a small tweak, so I don't think that will have a major impact per se. That's my view. Note that I'm a very big expert on the global macros.
You're being modest, Vikas, but here's my second question, therefore. Do you think a delayed Fed cut cycle would have a material impact on how flows or multiples behave? Or do you think that now, by virtue of the fact that the last 2 or 3 months, the data and the commentary has not been very dovish, that some of it is baked in?
If let's say, Fed kind of delays the interest rates cut, it could have some impact on that, because the emerging market flows are directly linked to the cut in this interest rate cycle. The good part is that the interest rates are peaked out. Other interesting part is that Indian currency is not expected to depreciate. To that extent, there is a kind of natural hedge available on that. So flows should start trickling in. I do believe that 24 calendar year could be a good year of flows. Having said that, any delay in the rate cut can have an impact on the flows.
Okay, because now you've been constructive on the Indian growth story and the implications of it for markets for a while now. It's played out really well. The last few days, we've seen some bit of moderation in the risk appetite, particularly towards the mid caps and small caps, but even the larger areas. Now, my question to you is, while India growth is, let's assume the GDP growth stays as most people are predicting, as the RBI prediction of 7% as well, could equity markets deviate a little bit in this year of some bit of global policy uncertainty? We have our elections as well, and the fact that valuations are also nothing to scoff at.
Absolutely, Neeraj. I mean, it's very natural that when you have a year like 23, which was a stellar year across the board, especially mid and small caps, it's a very natural thing for it to consolidate and because you can't have these kind of year returns very very often, right? But having said that, these are the kind of years of consolidation only are the years when you kind of construct your portfolio, because that is where you get good quality companies at a reasonable valuation. I mean, I have no doubt on that in my mind, right? So while I think from 24, you can keep your expectations low, but at the same time, this is also a great year to build your portfolio, is how I would see. There could be sideways movement, there could be some more correction. While when I'm saying this, I don't expect a deep correction in the market. I feel deep correction will come only if there's a unexpected, 3, 4, 5 sigma event, which you can't model for. But otherwise, the normal correction happens only because of two reasons: liquidity and leverage. And both right now are very well placed as far as the Indian markets are concerned. The leverage factor of in the market itself is also very, very low. The margin funding book of collective market is very, small given the size of the market cap and all. So I think it is leverage which generally accelerates the market falls. So I don't see a major deep cut in the market. At best, I think probably and save and except for some big unexpected event, I think it will kind of trickle, it will kind of remain sideways, consolidation, time correction might happen, and that's a good thing to happen in any bull run.
You might think that I invoke IT in almost every conversation that we do. Not that your view changes, because it shouldn't change quarter to quarter. But I'm inclined to ask this to you because of the deal that has happened in TCS, and Tata Sons valuing TCS at a slightly lower level than the buyback price. One. Two, there are brokerage notes out which speak about the commentary that select IT companies have given at various investor forums, including the Citi note on Emphasis, wherein when the company is saying that there is absolutely no change in the demand environment since the start of the quarter as well. Because for somebody who's wanting to put fresh money to work, is it a tad too early to bet on IT? I mean, for money that is already there, which is fine, but for somebody who's wanting to put fresh capital to work, are there better options than information technology currently?
Again, really, it really depends on your time horizon. Of course, there are better options than IT as well. So I'm not saying that there are no better options. I mean, probably pharma could be a very interesting one as compared to IT. Just if you look at the growth perspective and the change in the entire environment is happening, so you can always look for alternatives. I'm not saying that, but when you construct a portfolio, it's a balance of pretty much a lot of factors, and IT definitely offers a good hedge, good. And for as far as we are concerned, we've been very constructive on especially the mid and small cap ITs where the growth prospects are very high. We are very constructive on IT companies which are focused on ER&D space. We're very focused on companies which are more focused on the product space. So that is where I think the real growth lies. So IT, you can't look at with a broad brush. You have to, even while the sector is growing, at a moderate growth. Within that, there are many companies that are growing at 20% plus, and it is our job to identify those companies and kind of bet on that. And if one is able to find that, whether fresh capital or existing capital makes no difference, you can definitely put it, because IT continues to remain an interesting play even over next 8-10 years, and IT will pivot. It's not that current IT form will keep on. I mean, IT today is very different what it was in Y2K time. So I think every time there's a transition in technology happens, there's a pivot which happens. Most IT companies do that, and today they are pivoting towards AI and related technology, apart from cloud digitization and cloud migration. So this sector will keep evolving, but I have no doubt in my mind that sector will be relevant. It will grow from here. It will continue to kind of deliver good value creation.
So sorry, I just heard you mention ERD. People also talk about enterprise businesses, which is a small subset, but doing well. And then there is the larger IT services chunk. So is IT services still in the fray, or are ER&D and enterprise solutions parts of tech a better aspect?
It's still in fray. I mean, IT services are not going anywhere. Within that, I think ER&D will be faster growing sort of part, right? So so ultimately as an investor, what we are chasing basically growth and growth at a reasonable valuation, right? So wherever you find this, and especially in any sector, growth is what determines the outcome, right? So if you are able to get a reasonable valuation at a good growth, then I think sector by and large governance is not an issue. Most companies are good. So if you find a good business with a good traction in the growth, you go for it. And those are the kind of companies, especially ER&D as a space, is growing faster than the conventional IT services. And that's the reason most of the plays we have a larger portion of that, which is driving both profitability and the growth. And conventional model also continues to do well. It's not that it's under big stress and it's not doing well. That also continues to do well. So ideally, where you get both combination or a accelerated in form of ER&D, you go for that.
Got it. Before we take that break, since you mentioned healthcare as being a sector that could have, a good run too, or I mean, not verbatim, but you said something like that. Maybe better than IT are the prospects of healthcare. It's a wide bucket now, because what within this do you like the most? Because when you joined us in the opening week, you were of the view that CDMO CRO seems to be set for multi-year growth. Is that the first amongst equals?
I'm more specifically meant for pharmaceuticals and all. I mean, of course, healthcare has a wider this thing, including hospitals and diagnostics and all. Uh, you know, the pharma piece has reasonably good legs. It's come out of a long time of hiatus, and I think we are seeing demand environment in US changing significantly. We are seeing CDMO and CRO getting a, in my opinion, decadal, shift from China plus one. Of course, right now because of the biotech funding drying up, it's been a bit slow. But if I take a 5-10 year view, I think, just like how IT services grow, you will see CDMO and CRO places, companies will grow over next 10, 15 years. And I won't be surprised if there are, many CDMO, CRO companies, which could be 2, 3 lakh crore market cap in times to come. And this will happen in front of our eyes. So, again, depends on your time horizon, portfolio allocation. It's a combination of all. But we remain very positive on pharma as a segment and CDMO, CRO as a subsegment of that.
Okay, because the PSU move taken a bit of a breather. I wouldn't say it got derailed, but has certainly taken a bit of a breather. It was the toast of town until recently. How are you thinking about it?
Absolutely, just like how you see that, after every such a sharp run, last year was a stellar year for you, PSU. After such a sharp run, it is very natural for it to consolidate. And in case of some PSUs, I think probably a bit of an overstretch also happened. So, again, it is not PSU, you can't brush it to the broad basket, but there are PSUs where still there is a lot of value. Of course, some part of the deep undervaluation went away. Today, they are in a fair value zone. But I guess as the transition and transformation continues to happen, I think we will see more valuation re-rating happening. So I would say large part of the run is done, and now we will mostly track the earnings growth as Indian economy keeps growing. So and also you have to look at sector specific. You really can't, because each PSU in a different sector will have a different lever for growth and delivery of returns. We've been very, very bullish and positive on PSU banks. We haven't sold any. We continue to remain invested because we think that will do well. Power sector, we've been quite bullish. We have continued to hold. So we haven't really sold anything because I think these kind of consolidation, correction, temporary things will come in every market cycle. And we would like to just continue to hold and play out the full story.
Uh, in some sense, is the market getting unduly worried about what's happening to oil marketing companies? Moat around the business looks okay, but yes, there has been some intervention and some uptick in crude prices, but the derating has been very significant.
To be honest, we haven't really bought any of the oil
Okay.
marketing. That's why I'm saying that you have to look at different sectors. We do where we think there's a good management control on the future on the fate of the company and the sectoral tailwind. Unless we are convinced about these two, we won't buy. And specifically in the PSU segment, in any sector, any ownership matter, but especially in PSU segment, especially oil marketing company, that it's not been the CMD of oil marketing company doesn't control the outcome. There are lots of variables. So we have never kind of taken bet on that.
Got it. Because we are going to be talking at length about this on a separate show, but the headline of the article or a note that you've written recently is intriguing. The India story re-begins, Bharat Amrit Kal. What are you trying to say from an investing perspective here?
So Neeraj, I think, very often we get a question that, what is happening with the valuation, what is happening to the markets. So when you zoom in, you're worried about here and now short term. In this note, we're trying to say when you zoom out, your perspective can be very different on the Indian story. You can look at very, very different aspect. And if you are zooming out and seeing, let's say, next 10, 15, 20, 30, 25 years, your perspective about how to look at in equity investing changes completely. And this is what we're trying to, kind of say here in this note. As you know that India is embarking on the journey to become developed country by 2047, which means that we will have almost 29 to 30 trillion dollar of GDP, which is between 7 to 8x from here. So what are the possibilities as it happens? Why we think it can happen? And in India, many changes have happened. And to give you an idea, today's corporate profitability at a country level is $150 billion. In 2001, it was $8 billion. And despite all kind of uncertainties in last 22 years, Indian corporate profitability has become 20x, right? Now, this corporate profitability will go from 150 billion to $1 trillion by 2035. It means our market cap will be between 18 to 20 trillion dollar. It means our Nifty will be anywhere in and around 1 lakh. Now, if this is the kind of journey you have next, 10 to 12 years, then you don't really worry about what will happen next quarter. Not to say that, our job is to keep an eye open, but you don't really then try to say, oh, let me book a profit and come back and buy 5% cheaper. So if you look at this perspective of over next, 10, 12 years, massive amount of wealth will get created, and you just focus yourself on participating in that without getting bogged down by the short-term intermittent noise which is there always in the market. And this is the perspective we are trying to build. Also, we are trying to saying that what has changed in India? Why do you think it's possible this time around? India has always been a promising country, but that is where we are saying there are big mind shifts change have happened in India, and those mind shifts change are which are driving. Number one, which I always say that India as a country has moved from incremental mindset to exponential mindset. Today, we are executing everything at a rapid pace, as of yesterday kind of mindset. This is a very big change, very big departure from the past. Likewise, India doesn't operate from a constrained environment anymore. We're saying we have resources for everything and we don't act like a poor country anymore. Our mindset has changed from, big time on that. Like that, there are many 6, 7 tectonic shifts which have happened, which we think, will make sure India will reach to that, size and scale over next 20, 25 years. At least our conviction on that is very high as we analyze, and that is very well articulated in the note in a very detailed manner, that what are the big departures from the past and what are these tectonic shifts and what will drive the future of the country. So we think that we are in a massive wealth creation cycle over next 10, 12 years, of course, over 25 years, but the acceleration will be far, far, far more higher in next 10, 12 years. So, that is one should look to capture rather than worrying about, what will happen over next 3 months. So this is our whole perspective. What we are calling is in, Bharat Amrit Kal period, what will happen.
And because just before we wrap up, though, so 60 seconds left, but there are investing implications for this in a meaningful way. You launching a portfolio on this as well.
Yes, absolutely. And so so one is that opportunity we are showing, and then how do we capture it? Around that, we have a fund called Bharat Amrit Kal Fund, which we are launching, and you will see, that coming out soon. And so, how do you capture this massive wealth creation opportunity ahead of us? And that is what we'll be talking about.
Okay, well, Vikas, let's get you on a show to talk about this because our viewers can certainly benefit, even if they can't invest in your fund. If they can't, they certainly benefit from the conversation that happens around it. So, looking forward to that. But thanks so much for tuning in to joining in on Talking Point today, Vikas.
It will be my pleasure. Thank you very much.
Yep, the pleasure is ours. And viewers, that's all that the time we have for this edition of Talking Point. Thanks so much for tuning in.